Hi, and welcome to the second session of digital marketing. We will talk about digital marketing metrics. actually several forms of there are several advantages of customer lifetime value. So one of the main ones is to generate ROI on customer acquisition. Which I mean by that is to juxtapose the cost of customer acquisition, or CAC, to customer lifetime value, CLV. You can enhance your retention marketing strategy, you can create more effective messaging and targeting, and you can improve the output from customer support. So you want to have a return on your investment, right? So for the investment, you will take into account the customer acquisition. How much money have you spent for the advertising in order to gain this customer, right? And how much money has this customer generated? So for the customer lifetime value, there are two forms of calculating it. One of them is to use a margin to multiply this by the retention rate subdivided by 1 plus discount rate minus retention rate. And another formula is the annual revenue per customer multiplied by the customer relationship in years minus the customer acquisition cost. An example, for instance, would be you have a software company that generates $3,000 every year per customer with an average customer lifetime of 10 years and a CAC of $5,000 per customer. The company could calculate CLV like this, right? You would have the $3,000, right? And this is the average order per customer per year. And you multiply this by 10, which is the average customer lifetime in this case. And then you take the $5,000 investment out, right? The CAC, the customer acquisition cost. And at the end, what you will have is a CLV of $25,000. The CLV analysis shows the impact of the sales and marketing budgets required to land new clients. And the CLV analysis is really quite crucial for us marketeers because it gives you an argument to increase the investment. Of course, you need to have a ROI which justifies this, and this is how you calculate it. There are also CLV ratios that tell you if your company's budget is wasted or used properly. The ideal CLV ratio is 3:1 for CLV to CAC. So if the CLV to CAC ratio is too low, smaller companies, especially startups, do not generate sufficient revenue and you have a major problem. And here on this graphic you can see, right, you have the customer acquisition cost and it should always be much lower than the CLV, right? Otherwise you will not have ROI which makes sense. Of course, I'm talking here about revenue, so I'm talking about income management. And in this case, it's very, very important to focus on price rather than cost. So to use price balancing. What I mean by that is when there's too many competitors using a lower price than yours, you will probably have a problem. So you need to adjust the price to that. But if there is a large demand, of course, it's always the law of demand and supply. If there's a large demand, you can increase your price. And it's always important to keep an eye on the market-based value, right? So you need to have a look at what is going on in your market and what is the market-based price. It should rather be a market-based price instead of a cost-based price. Because if you have only a cost-based price, you will be your price will not be adjusted to the market and you will probably lose a lot of clients to your competitors. Another thing which is important is that you need to sell to segmented micro markets and not mass markets. So you need to really be careful with your targeting, with your segmentation. Not every product is useful for everybody. And most of the times that you have really generic audiences, your advertising will not work and you will not be able to sell your products or services. So that's what I've seen. The more segmented you have your audience, the better you can work on it and offer also better prices. And what is important here is that you save your products to your most valuable clients. Another basic concept here is to make decisions based on data, not assumptions. You will always need to look on data before you take decisions about revenue, and it's very, very important to have a look at, as I said, the CLV, the CAC, and then also to the price evaluation in your market and in your and for your audience, right? Another thing which is important is to take advantage of the product's life cycle. And here I'm talking about the life that you know, let's say how long your product will last. If you have a very short life cycle, you will need to the revenue calculation will be different, and then your CAC will be different, and then your CLV will be different. And you need to reevaluate your business opportunities every now and then in order to be up to date on sources of revenue.